First of all, greetings to you and thanks for your time for speaking to me. And so please let us know about yourself. How did you happen to get involved with blockchain and your journey with DCM so far?
Well, I was actually asked to manage an investment fund, which, as I found out, was actually the first investment fund in the crypto space. And that was about 6 years ago. It wasn't my fund, and it was an index fund, a Bitcoin only fund. So people subscribed, we purchased Bitcoin, people redeemed, we sold Bitcoin. And after doing that for a year, and at the beginning of that year, I thought, Bitcoin, this is the stupidest idea I've ever heard. But at the beginning of that year, so that was my attitude then. By the end of the year, I thought, this isn't bad. But I don't like a passive vehicle. I didn't like an index vehicle. And due to completely unrelated events, I was shutting down another fund that I did own and manage. And rather than shut it down, I decided to repurpose it and shift over into the crypto space. So I did. And this was the beginning of 2000, end of 14, beginning of 15. So it did very, very well. And I actually put some of the fund into this index fund, because the fund I was shutting down was a fund of funds. And so it actually still owns the all-time performance record for a fund of funds, which I suspect one of these crypto funds of funds will take out when we have the next bull market in the crypto space. Mm-hmm. And so I'm still overseas, that outside the United States, rather. As you can tell from my accent, I'm a Yankee, but I've actually done very little business in the US. And I moved back to the US. It proved to be difficult to run a basically overseas offshore structure from the United States. So I shut that fund down, created one in the US, and things have been going great guns since.
Nice. So can you share us a few case studies of blockchain use cases implemented by your team and how they are benefiting the clients?
Understand there are really three things in the crypto space. There's trading tokens, which is what my fund focuses on. Then there's the blockchain space, which is related to certain trading tokens, and certainly the tokens that use a blockchain, but that doesn't really make them a blockchain investment per se. So blockchain investments with serious use cases mostly apply to VC or PE investments. And then the third part of what we call crypto, and in fact, I published an article called the crypto trichotomy, which if you look in CoinDesk, you'll see it, and there's the same categorization, trichotomy, because there are three, and the third piece is tokenization, or the atomization of ownership. You really don't have, there's nothing to do with crypto. There's no relationship with crypto and tokenization, although I think it's that last piece that is going to be the biggest. The first two are very different, right? So they're very large tokenization projects going on where there's not a token that has that anyone is trying to say is external market value. And because of that, the only way to invest in such projects, and many of them are private, so like an IBM Maersk deal, right? It's completely private. You can't invest in those. So in terms of use cases, there are millions of them, and I talk about them a lot because in various fora because I find them fascinating. But when you're talking about my fund, you're talking about trading tokens. And at that point in time, you're talking about technical indicators, fundamental indicators, market trends, participants, various other things. So the question doesn't really apply to the fund. If you're going to go that way, I'm happy to, but bear in mind that you're sort of changing the subject.
Okay. So for firms holding substantial reserves of Ether and Bitcoin, you were recommended to reinvest these assets. So what's the rationale behind such advice, considering both Bitcoin and Ethereum are always on the upward trend, year after year?
The first part, which is they want to invest BTC and ETH.
Right. So we found this recommendation on your website, so we wanted to ask you and understand.
It's actually fascinating, and it's a good time to ask this question because for U.S. investors anyway, because it's tax season. The thing about most people who own a lot of BTC and ETH is that they have a very low basis in it. They paid very little for it as a general rule, and it's worth much more now. So if they invest it, if they sell it and do something with it, then they realize that gain, they have a lot of taxes. So you'll never get out of the taxes, but you want to push it down the road as far as you can. So for those people, we actually have a share class, one denominated in BTC, another share class denominated in ETH. And if they invest in that share class, that investment isn't a taxable event. And we buy and sell the BTC and ETH, so they will incur taxes as we do that, because when we sell it, they have a realized capital gain, they pay taxes on it. We buy something else and presumably sell it higher, then they have another gain, so they will pay some taxes. But we're actually thinking, so anyway, that investment is just fine. They're making more BTC or ETH. They're also incurring a tax burden, and we'll help pay that. But the other thing is, we've actually thought about a structure where we never sell their BTC and ETH, where when we want to buy something, we leverage long, and where we think the market's going to go down, we short, but we never sell the core assets. At that point in time, they would never have a basis increase, never an increase in value that they realize. They would simply have some profit over and above that. So their original BTC or ETH would keep that very low basis. They wouldn't incur a tax penalty, yet they would be earning more BTC and ETH. So we're sitting on the fence there. It only applies to shareholders in certain jurisdictions where they have an approach to taxation similar to what the US has, but we're asking our investors now which of those two they would prefer. But in any event, it allows people to earn much more than they are able by lending. Using last year as an example, our Class B, the BTC was up 20-some%, and our Class E was up about 70%. Even though BTC and ETH went down a lot in dollar terms, it's nice to have a bunch more than when you started.
Okay. So what measures an investor should take to identify the genuine projection of trending crypto volumes versus, fake hypes? This is with reference to the recent report by Forbes stating that 95% of reported Bitcoin trading volume by coin market cap is fake. So what is your take on this?
I don't know whether the numbers are correct. I wouldn't be surprised if they are. But if you read the article, and it was a great headline, right? You read an article because of the headline, but most people took the headline and didn't read the article. The article actually says that the larger exchanges have legitimate volume. That's not where the problem is, and the inflation.
Very countable number. I mean, like 10 or 15 exchanges they have genuine projection of the coin market cap. As far as I remember.
I didn't catch the question, sorry.
No, I said no, they mentioned in the article that about 10 to 15 exchanges actually put the correct figures.
Yes, exactly. Yes. And so we don't trade on the smaller ones. We don't trade on those that fake their volume. I don't think many people do. I mean, because they fake their volume, they're trying to get the impression that a lot of people trade on them, but they don't. So it's a great headline. I'm not sure if it's really a substantive problem.
Okay. So we notice an increased adoption of asset tokenization into the mainstream capital management. So how can this benefit the masses and underprivileged?
Why do you think that there are more going into mainstream, or that there are more mainstream investors investing in crypto? Why do you think that? I'm asking you a question.
Okay, so this is because we see a lot of reports across the globe that it's getting more and more popular. So we were under the presumption that it's getting into mainstream slowly.
There have been a couple investments, notably from Harvard and a couple of other investment funds, that have been made by traditional investors in the crypto space. Absolutely. I don't know. I wouldn't conclude that they are all that significant. And they're in a very specific space, right? Because you're talking about the blockchain investments I was talking about, where they're not trading tokens. Mm-hmm. So while it's interesting that some of that is starting, it's not nearly on the level, again, that the headlines would have you believe. I think blockchain has pretty much entered the mainstream because people realize what the value of trust is. And that's really the only value of blockchain. It's what blockchain provides, is trust. That has value. Trust has always had value. However, trading tokens and trading in a market, in an area where the market cap is $170 billion, to say that there are a lot of institutions crowding into that space just isn't true. The space is too small. There's no way that it could accommodate a significant investment from even one large investor. Mm-hmm. People are testing it, putting their toe in, but not much more than that.
Okay. So are the current rules like how we test, KYC, AML sufficient enough to identify or classify tokens as securities? Does the SEC recent guideline streamline the process with a better clarity?
I don't know that the SEC's issues are around KYC and AML. Mm-hmm. KYC and AML aren't that hard to do, and there are lots of third-party companies that will do it for you. So I don't think the KYC AML really is something that's a constraint with respect to security tokens. Ensuring that you have a class of investors, such as accredited investors in the United States or similar names elsewhere, that is something that one needs to do. And that's why there are things like T0 and Binance is setting up an exchange to do the same thing, where you want to ring fence certain investors. Mm-hmm. But the SEC is taking the existing law and saying, hey, this is investment, so you have to follow certain rules. Those rules extend, KYC and AML is probably 2% of those rules. So I think the question is putting the emphasis where there really shouldn't be that much emphasis.
Yeah, right. So how can the STO firms protect themselves from being vulnerable to regulatory breaches before launch? Or do you see any gray area in the regulation itself that leads to ambiguity in compliance?
Sorry, in terms of what? Ambiguity in compliance in terms of what?
I mean, the regulatory regulation itself, is it clear, or do you think the companies can take more precaution in terms of the breaches, or preventing from breaches, regulatory breaches?
Oh, violent regulatory violations, right? The regulatory landscape is incredibly varied, and it's not complete in any country, with the possible exception of Malta. And even if it's not complete in Malta, Malta is much further along. Mm-hmm. So from one perspective, I suppose theoretically it's actually impossible to be completely compliant. And it's almost certainly impossible to be completely compliant in every jurisdiction. So the companies try, STO companies try, and some of them have done a remarkable job recently. But even if you take like the IEOs, the initial offerings that are being done on initial exchange offerings done on Binance, there are real questions as to whether that they fully comply with Maltese and EU regulation. They're certainly trying, and that's great, but I doubt very much they're fully compliant. Are there things companies can do? Sure, but the first thing a company does is go forum shopping. We're working on a project now, pardon me, and one of our first conclusions was, okay, this can't be in the US. Where can we put this project so that we can have a friendly and appropriate regulatory environment? So that's the biggest thing. Companies have to forum shop, find a good forum for what their project is.
Okay. So the SEC also rolled out another major update, the no action letter. So can you take us through this and how it would impact the crypto landscape?
Very much. I mean, if you look at what the SEC issued that no action letter for, it wasn't an investment. In short, there's this test, this 4-pronged test called the Howey test. It met none of those. There's no way that was even a security. It's like me going to the SEC and saying, look, I want to sell you this can of Coke. Please tell me it's not a security. Well, no kidding. There was nothing new in that no action letter. Again, it was an example where the headline seemed to promise a lot, but the substance, in that case, it was literally nothing.
Mm-hmm. Okay. So in your recent article on the trichotomy, which you just spoke about a while ago, you spoke about 3 verticals of crypto space like trading tokens, blockchain, and asset-based tokens. So how are they different and significant?
What? Say that again?
Your trichotomy article. Okay. The question is, how are they different and significant?
I explained it already earlier now, when I already talked about the 3 verticals. And I think that pretty much answers. The one thing I'll add, though, is valuation. The first vertical of trading tokens will be worth single-digit trillions. Mm-hmm. The second vertical, which is blockchain projects, things I was telling you about, that will be almost certainly be worth double-digit trillions. And tokenization of real assets, or the atomization of ownership, as I've taken to calling it, that will probably be worth triple-digit trillions.
Mm-hmm. Okay. So there were reports about launch of US stocks, a token representing ownership of US stocks. Is the stock market on the verge of adopting blockchain and cryptocurrencies?
I think there are incremental advantages, at least in the US, to tokenizing stocks, because the stock market is very efficient and the transaction costs are basically approaching zero. Settlement of stocks is something else because the settlement process is slow. So if you're in the US or in most countries, you sell your stock, yes, it's sold. If you want to buy more stock, they'll let you buy immediately. But if you want to pull your cash off, you have to wait 2 or 3 days, which is T2 or T3, hence the T0 project where they put stock trades on a blockchain, you have instant settlement or near real-time settlement. That, in terms of settlement, there's clearly an advantage. In terms of tokenizing equity shares, when those equities are already freely tradable, I don't see a significant advantage.
So the Chinese government is reported to be planning to ban Bitcoin mining. Considering the gigantic Chinese economy, do you feel this would have a spiraling effect on the crypto ecosystem and adoption?
The Chinese government has been trying for years in one form or another to ban crypto and has failed miserably. So I don't think this effort will have any greater effect. It'll just force the Chinese to adapt again, and life will continue basically as it was.
Right. So one last question before I wind up. In September 2018, there was an allegation on MCAM of SEC violation. Can you talk us through the sequence of events, if you would like to?
I'm limited in what I can say, but what happened was there was an inquiry. There was never an investigation. There was an inquiry. We cooperated with the inquiry. We made a settlement offer. And in that settlement offer, we neither affirmed nor denied what the SEC said. We settled, end of story. The one thing I will say, though, is that the SEC paid a lot more attention because it was in the crypto space, and things would probably have not been so formally resolved if we weren't in the crypto space.
All right. Thank you very much, Mr. Timothy. Thanks for talking to us, and we appreciate your time and your thoughts.
Thank you very much. Take care.
Thank you very much. Take care. Bye-bye.
Bye-bye.